Welcome to This Explainer. Today, we're unpacking the incredibly precise rules that hold the mortgage industry accountable. If you've ever signed on the dotted line for a home or even just watched the housing market from afar, you know exactly how complex lending can be. So, we're going to cut through all the jargon and reveal the strict reporting standards that keep lenders in check.
Okay, let's dive right in by grounding ourselves in a reality we all remember pretty vividly, the 2008 financial crisis. This quote from the Sustainability Accounting Standards perfectly captures the massive shift we've seen since then. There was a huge push to permanently protect consumers from predatory lending. It isn't just about ticking compliance boxes anymore, it's about proving that the financial interests of big lenders are actually aligned with the health of society.
To understand how the industry prevents a repeat of 2008, we'll be looking at four key areas: the transparency era, distressed assets, the cost of miscommunication, and tracing incentives.
Kicking things off with Section 1, the transparency era, and this new standard for accountability.
We're going to follow a reverse cause and effect arc today, starting with the fallout of failed loans and tracing it all the way back to the source. Now, lending capital for homes is undeniably an essential public good. It builds communities and generational wealth. But regulators realized that pure, unfiltered transparency is literally the only way to ensure lenders are giving fair advice. Without it, it's impossible to know if a portfolio is filled with solid investments or incredibly risky, unsuitable products.
That brings us to Section 2, tracking the visible fallout through distressed assets.
Let's look at our first specific metric, 270A2.2. It starts with a really tough question. What exactly happens when a mortgage fails? When a loan goes bad, companies can't just sweep it under the rug. They're actually required to transparently report the fallout in three very specific ways, so everyone can see exactly how much risk is sitting in their portfolios.
First up, they must report modifications. This is when a borrower needs to alter their original loan terms, maybe getting an interest rate reduction or extending the length of the loan just to stay afloat. A high number of modifications might be an early warning sign that the original loans were perhaps a bit too aggressive for the borrower's actual financial situations.
Second, and definitely more severe, are foreclosures. This is the visible fallout when a borrower defaults completely and the property sale is legally forced. The metric requires reporting of any single-family residential assets that entered foreclosure during the reporting period, regardless of whether they've been sold off yet.
Finally, we have short sales or deeds in lieu. This happens when a lender simply agrees to accept less than what's owed, or the borrower voluntarily hands the property deed back to the lender entirely, basically just to avoid the lengthy and painful foreclosure process.
And SASB requires entities to lay these numbers completely bare. You don't just get to say, hey, we had some losses. You have to specify the exact volume and the exact dollar value tied up in each category: modifications, foreclosures, and short sales, right side by side.
Moving into Section 3, the cost of miscommunication and the legal repercussions.
So what happens when those distressed assets are actually the result of bad advice or deceptive practices? We're stepping backwards in our chain here to look at the legal and financial pain lenders face when they fail their customers. When a lack of transparency leads to borrowers defaulting on products they never fully understood in the first place, the regulators step in.
Under metric 270A.3, companies are forced to disclose the total amount of monetary losses resulting from legal proceedings over how they communicated with customers or how they remunerated their loan originators. It puts a hard, undeniable price tag on bad behavior. And the crucial point here is that they absolutely cannot hide these costs. The standards require them to report everything, whether it's a civil settlement with a wronged homeowner, a regulatory penalty for deceptive marketing, or even a criminal judgment for fraud. If there was a lack of transparency, the resulting financial hit has to be disclosed.
But here's a really fascinating caveat to this metric. It strictly excludes the company's own legal defense fees and expenses. Why? Because regulators want that reported number to reflect the pure penalty of the misconduct, not how much they spent on expensive corporate lawyers trying to fight the charges. It is raw accountability.
Finally, Section 4, tracing incentives back to the root cause.
This brings us to the last piece of our puzzle. What actually motivates a lender to offer a risky product in the first place? To find the systemic root cause behind these lawsuits and foreclosures, we've got to pull back the curtain and follow the money right to the people sitting across the desk selling the mortgages. We are talking about mortgage loan originators. These are the individuals whose paychecks are fundamentally tied to the loans they arrange and negotiate. Understanding exactly how these people are paid is the absolute key to understanding the risk profile of the entire lending institution.
Metric 270A4 demands that companies explicitly explain their compensation structures. Do originators get a standard, fixed salary regardless of what they sell, or do they earn variable remuneration, like risky bonuses or commissions, that are tied directly to the size of the loan, the interest rate, or the upfront fees they push onto the borrower?
Think about it. If originators are incentivized to sell bigger, higher-interest loans just to get a bigger commission check, the risk of predatory lending absolutely skyrockets. That's exactly why disclosing these payment structures is mandatory. Companies must detail the regulatory environment they operate in, the performance objectives for their staff, how they measure that performance, and the exact structure of any variable pay. It exposes the engine driving the sales.
By tracing this chain in reverse, from the family-facing foreclosure, back through the legal penalties, right down to the loan broker's bonus structure, we see how these standards force the industry out into the open. Pure transparency acts as our absolute best defense against systemic failure. So having seen exactly how the industry tracks its own accountability, how will you use this knowledge the next time you or someone you know signs on the dotted line?